There's certain option strategies that can give you quick hit and run profits in the right conditions. And in this video, we teach you one that has the potential to make up to 100% profit overnight. I'm Seth Freudberg, and we are one of the top proprietary trading firms in the world with numerous 7 and even 8-figure per year traders. You found the right place to learn. One of the reasons that professional options traders very actively trade options during earnings season is that options provide unique opportunities for very large and substantial profits overnight that you can't easily find trading in any other kind of asset. And we're going to go over a vivid example of one of the main earnings season option strategies in this video. So if that sounds interesting to you, then stick around because I think you're going to find this pretty eye-opening. Before we get into the option strategy that we'll be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we've put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy that we'll be sharing with you in this video. Then, when you're finished, you can come back and watch the rest of the video. To illustrate this earnings strategy, let's take a look at the setup for last week's NVIDIA earnings release, which was scheduled to release after the market closed on November 20th. And as you can see, since early September, NVIDIA had been rallying, closing at 145.89 on November 20th, minutes before the NVIDIA earnings release. So let's say that 45 minutes before the close, we pulled up an options chain expiring that Friday, 2 days later on November 22nd, and we found the options closest to the current price of NVIDIA, which was trading at that particular time at 143.93. And so that would have been the 145 strike price. And so we go ahead and sell 10 of the 145 calls and simultaneously sell 10 of the 145 puts. Then at the same time, we buy 15 puts higher, 10 of those 160 calls, and we also buy 15 points lower, 10 of those 130 puts. Well, when we do this, selling the at-the-money calls and puts and surrounding those by long calls and puts on either side of those short options, when we do that, we are entering into what options traders refer to as an at-the-money iron butterfly, which expires in 2 days. Let's break down what's happened here cash flow-wise, because it's important to understand the cash flow so that you'll be able to see why this strategy is so powerful right before earnings are released. So starting with the 10 short calls we sold, you could see that they were priced at $6.02. But remember, each options contract represents 100 shares of stock. And so you multiply that price by 100 and you sold 10 of them. And so if you multiply it all together, you end up with $6,020 of cash flowing right into your account. And with that same kind of calculation, you can see that we collected $7,020 for the 10 puts we sold, but we also bought protection by purchasing 10 of the 160 calls. That cost us $1,590, and we also spent $1,550 on those long puts. And so when you net it all down, you end up with positive cash flow of $9,900 into your account, for which your broker will require you to have at least $5,100 in your account, which is the worst case scenario loss on this trade, by the way. Before we go into how this trade turns out the next day, I wanted to focus on a really important point about these earnings butterflies. Let's look again at the options chain that we've chosen for this trade, and I'd ask you to focus on that column entitled IV. Well, IV stands for implied volatility, and while this is a nuanced subject, just to simplify it, think of implied volatility as the amount of price volatility that the options market is expecting for that stock before that option expires. And as you can see, the at-the-money calls have an IV of 153.13, while the at-the-money puts have an IV of 152.46, almost identical. Just for comparison, let's go back a week earlier to Wednesday, November 13th, around the same time of day. And again, we'll pick an options chain that expires 2 days later. And since NVIDIA was trading in that same basic neighborhood of 145, the 145 options are again the closest to the stock's price. And so if we did the same thing, selling the calls and puts at the money and buying the calls and puts 15 points farther from the money, you can see that we would have collected $3,580 versus the $9,900 we collected for the earnings trade that we just put on, almost 3 times as much. And so you might be wondering, why did we receive so much more cash for the earnings trade? And the answer lies in the difference in implied volatility between the 2 weeks. You see, the options a week earlier, when there wasn't a major event coming up the next day, but rather it was just an ordinary trading day, those reflected in the implied volatility of the calls and the puts a very low implied volatility of 39.97 for the calls and 38.69 for the puts. Whereas in the earnings trade we're making, with that huge event coming up the next day, the earnings, the implied volatility of the at-the-money calls and puts were almost 400% higher, up over 150. And so the logic of this goes something like this. If you were the call seller of that 145 call, you've got to sell your shares of NVIDIA at 145 no matter how high the stock goes, as long as the person who bought that option exercises it. And the same for the 145 put. You're contractually obligated to buy NVIDIA at 145 no matter how low the stock goes before the option expires. Well, if an earnings event is not coming up in an hour, like the earnings trade we made on the afternoon before NVIDIA's earnings last week, then the risk of NVIDIA moving up or down a lot in 2 days is not that great. So the options we sold at the money aren't worth that much. And so the amount we collected for selling those options, less how much we paid for the protective calls and puts 15 points away, which cost peanuts in this case, the amount we collected for those is going to be way less than what we collected the afternoon right before earnings, where the risk of having to either sell NVIDIA at 145 if the calls get exercised when NVIDIA is trading a much higher price, or the risk of having to buy NVIDIA at 145 when the stock is trading much lower and the puts get exercised, since either scenario is likely to be a lot more dramatic right after earnings, then the amount of price built into those options is going to be much higher to cover us for that risk. And so that inflation of those options prices right before earnings is known as the implied volatility build, or the IV build for short. That price expansion that happens to options as they approach earnings. And it gets really intense the day right before earnings are announced, which accounts for the huge implied volatility of the November 20 trade and the huge positive cash flow we received as a result of that high implied volatility. Okay, so now that you understand the impact of earnings taking place imminently on options prices, let's move to the next day after earnings were announced. And as you can see, the stock opened up trading at 149.35 right off the opening bell. And so let's take a look at our options trade 30 minutes later into the market, during which NVIDIA sold off a little bit off the open and now was trading at 144.26 by 10 a.m., which is very, very close to where the stock was trading when we entered the afternoon before, when it was trading at 143.93, you might recall. So basically at the same price. And so I want you to take a look at the prices that next morning. And as you can see from this slide, in that one day, with virtually no price change at all of the options had a dramatic drop in pricing, with the short calls and puts both losing more than half their value overnight, and the long protective calls and puts dropping down to basically pennies overnight. And why is that? Well, think about it. The afternoon before, the earnings were an unknown. The market had no idea how high or low the stock could move that next day, because NVIDIA particularly has a history of dramatically moving as a result of its earnings release. And so option sellers have no choice but to build huge prices into their options because of taking so much risk of a big move that would force the call sellers to sell NVIDIA shares way below where they are trading after earnings, or for the downside, the risk of the put sellers having the contractual obligation to buy NVIDIA at a price much higher than it's trading. And so right before earnings, both scenarios are definitely within the realm of possibility, and so the options are priced very richly. But what about the next morning? Well, the next morning now, NVIDIA's earnings are known. And more importantly, the market's reaction to those earnings is known. And in this case, the market actually didn't have much of a reaction, initially rallying weekly, and now 30 minutes later, selling off mildly. And so now that the market has spoken and its reaction simply isn't dramatic in either direction, then the options expiring the next day can now return to more normal pricing, because what was a big risk and a big unknown is now a small minor known. And so option sellers don't have to build much into the options that they're selling, and the prices can be normalized. And this process of going from inflated prices pre-earnings to normal prices post-earnings is known to options traders as the implied volatility crush, or for short, the vol crush. To close the trade, all we need to do is reverse the transaction, buying back the short calls and puts and selling off the long calls and puts. And so starting with the cash we originally received for selling the earnings iron butterfly, the 9,900, then we subtract out the cost to buy back the short calls at a cost of 2,150 and the cost of buying back the short puts for 2,830, and then selling off the long calls and puts, which weren't worth much at that point, resulting in a total net profit of $5,100, which is basically what is left over from the original cash flow minus the cost of closing the trade. And it happens to be a pure fluke, but that's exactly the amount of capital that your broker would have required for this trade in the first place, resulting in exactly a 100% return overnight, which again is just a fluky coincidence, and it's basically never going to happen under normal circumstances. And so what I'd like you to take away from today's video is that earnings season brings about many, many situations like this where the options related to a particular stock will have that explosion in implied volatility, which in turn translates into a huge increase in that stock's options prices, which gives rise in turn to opportunities like this 100% overnight return. Now, of course, this trade can lose as well, and that happens basically when the stock moves much farther than the options market anticipated, in which case the cost to close the trade will be larger than the cash received to open it. So you need to know that there's definitely risk in this trade, but under the right circumstances, as you can see, there's a potential for a huge amount of profit overnight using earnings butterflies during earnings season. Professional options traders are trained to understand how options act as their underlying stock approaches earnings. And if you do your homework, you can find opportunities for earnings iron butterflies every earnings season.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.